One more special voice, Chakri Lokapriya, Managing Director at TCG Asset Management, joins us right now on the show. Chakri, so good having you. Thanks much for joining in. Well, this morning seems to be about commodities, not financials to a certain extent, yes, but it seems to be dominated by commodities. Tata Steel numbers out. Oil marketing companies very sensitive to the rupee movements, down yesterday, marginally higher in the session today. What have you made of all that's happening within this pocket in the recent past?
Well, if you look at metals, it's a tale of two halves in the terms of you look at their volumes and pricings are up, multi-year highs, 3-year highs, 4-year highs. And if you look at the stocks, they're all year-to-date down. And partly they were all down in the mid-cap correction and the overall correction and the uncertainty of the global events. But the demand is continuing to be very strong, will continue to be strong for at least the next couple of years. And when you talk to aluminum manufacturers or steel manufacturers around the region, not just India, you can see many of these guys are actually expanding capacities, debottlenecking, because they're seeing end demand. So against this backdrop, I think valuations look attractive, and I would be a buyer of all the frontline metal names.
All right, Tata Steel there, FY20 PE at about 7.63. So does that look like a fair valuation for you?
Tata Steel has a couple of things going. One is because of the recent acquisition, their net profit margins are lower, their debt will look slightly higher. But once the iron ore integration and various other synergies take place, then the numbers will start looking far more attractive in terms of earnings, which are not there right now because of some of the recent Bullish Steel acquisition. So I think from that perspective, yes, the valuation looks fine for Tata Steel, and I would be a buyer at current levels.
All right. We've passed through almost the entirety of the earnings season. Any specific pocket that disappointed you?
Well, disappointed in the sense that you are continuing to see a slippage of in some of the PSU banks, but SBI has been good in terms of they've upfronted all their losses, and they've increased their provisions, which is a good thing. Not just a good thing, it kind of is a signaling mechanism that they are comfortable taking it upfront. But some of the smaller banks are still having problems. The power resolution is still not clear, which is reflected in what's happening to Union Bank. So I think that is going to be the most important thing to watch out for.
Interesting. Chakri, you have this penchant for picking up specific pockets, mid-size, small-sized, and watch them grow over a period of 4 or 5 years. So the contrarian question to Devina's question, anything that stood out really well for you? I mean, you looked at the numbers and you said, wow, how did I miss this?
Yeah, if you look back at the last 2-3 months and the carnage that happened, the number of stocks that corrected, the two big sectors which got hit was one, industrials, and second is consumer discretionary. And industrials, it was a fear that maybe the government will slow down in its execution, and therefore the stocks came off, which turned out to be not true, because the current quarter earnings turned out to be a good quarter, and their guidance is also good. And the same thing happened with consumer discretionary, right from autos to including the retail names. And we've recently looked at Arvind, which is a market leader, very good brands, and the company has corrected quite a lot. The company has a couple of restructuring plans going on in demerging its various divisions to unlock value for its retail and textile business. And so that's one thing which we've added in the recent fall. And the other one we added was Ashapura Intimate, manufacturer of women intimate wear and innerwear. And this company is trading at a far cheaper multiple than all the Page Industries, etc. of the world. And this is a company where it's now trying to invigorate its brand. It's putting out stores out there, standalone stores, and they're increasing their distributor reach. And it's trading at probably at about 18-20 times for earnings well in north of 35-40%. So this is another one which we picked up recently.
I like the fact that the promoter, one, is putting in fresh money. I mean, he's investing himself.
Yes.
And when they did that swap of Ashapura Intimate Fashions with MoMA Apparel, he had the choice of not leaving out so much on the table for the minority shareholders, but he left. It just shows that the promoter's interests are aligned with the interests of the minority shareholders. Does that work for this company? The reason I also ask this is because aside of the technical trigger, somehow this stock, despite good performances, has not been able to really move up the way the Pages or the Luxes of the world have done?
Indeed, absolutely right. I think this is something which has kind of hurt the sector itself for the last few years. If you look back even at Lovable Lingerie, they got their product positioning kind of mixed up. Were they luxury, were they mass market, were they somewhere in between? They didn't get that act together. But I think now Ashapura is trying to price itself as a mid-premium kind of a brand, and which has for not just tier 1 but tier 2, tier 3, the markets are expanding. So, and the valuations are attractive. So I think one, with their execution of distribution reach, and two, brand positioning, maybe this time around it will work for the company.
Would you buy a Page or would you buy an Ashapura if you had a choice?
Well, I've bought Ashapura at about 18, 20 times. But Page is a lovely company. It's trading at like, whatever, 60, 70 times. So I'll stay away from it for now.
The auto pack, you were talking about that earlier on with the results that came out from the two-wheeler pack, a Bajaj Auto versus a Hero MotoCorp. And then what did you make out of the pain points for Tata Motors?
Tata Motors is all about JLR, I believe. And so, whether the CV cycle does well or the domestic does well, it's less important as a driver for the stock rather than what's happening. And that JLR is not going to fix itself until Brexit fixes itself, which is unlikely to happen because there's still no deal for a Brexit. And so against that backdrop, it's very unlikely that...
So no matter how much the stock falls and however cheap it gets, it still doesn't make sense to go into that stock?
No, I guess at some point, but I would still not be a buyer at current levels of Tata Motors. But at some point, if there is a price.
Aside from that, the auto ancillary space now is looking for uniform GST across the board. If that sort of comes in, that will be an additional plus point for the entire sector. Do you think there are good picks out there too?
There are lots of good picks because one of the advantages for auto ancillaries is they benefit from a domestic market, and they also benefit from an export market. So there's kind of some kind of backstop to their volumes with the domestic thing, with the domestic demand. And with exports markets in general being very strong, the economy is doing well. So this cycle is going to last easily a couple of another years. So we recently did Minda Industries, and so these guys supply to just every single OEM in this country, and they're doing some acquisitions outside the country, and this is both for product know-how as well as in product reach. And this company, so therefore I think it's doing a good job with doing acquisitions. Organic growth is strong and is trading at a fairly attractive valuation, and the revenue drivers are very visible for the company's growth. So this is one of those that we added recently.
It's run up 58% already this year. There's more headroom.
Yeah, there's still a lot more to go because 58% is... I mean, mind you, the stock had a good amount of debt, there was uncertainty, etc. And so it's coming off a very different base.
Interesting. Well, auto components. Actually, if I can stretch that conversation just a bit more, the one that has not performed is Motherson Sumi. What happens there? Vivek Chand Sehgal seems confident of reaching the numbers that they forecasted for 2020 and reaching that return on capital for the group as a whole at those higher 35-40% odd levels.
He's an excellent entrepreneur, and I've interacted with him several times over the last several years. And one of the things which has held back the stock in the past was the number of acquisitions and some of the group structure. And some of the discount came off. But in times of uncertainty and also what's happening with the trade wars, that uncertainty has held back that stock right now. And I think so that is one of probably the main reasons which is holding back the stock. And it'll probably, that's more a sentimental thing, which will hold probably water for some more time, i.e. the stock is unlikely to run anytime soon.
Interesting. How are you picking financials, Chakri? My last question really. What are you choosing and why are you choosing them?
Financials, I think, some of these corporate facing banks, they've been, ICICI trades at probably around one times book. So we all know the well-known issues, so we think the stock does well despite the uncertainty. SBI, again, same story, which is the largest PSU bank, 20% plus market share. It's trading around one times book. You know all the pain points well. and therefore that's another one. And Axis Bank, slightly more expensive. Again, well-known story, well-discovered story, similar problem. So it's largely the corporate banks.
Yeah, you're looking at HDFC?
HDFC, the parent, I think yes, those are like must-haves, the HDFCs and HDFC banks, yes, but incrementally we'll add to the ICICIs of the world.
Like in terms of your investing view, of late, till we actually did see the index rise up, the view was choose those large caps, those quality stocks. But obviously those quality stocks are no longer cheap, they're very expensive. So the value in that buy isn't probably no longer there. Versus the mid caps and the broader market, smaller cap space, which seem to be reasonably valued. Which side would you tilt more towards?
It's a very interesting thing. We did some work and if you looked at it, there's only actually 3 stocks, HDFC, Reliance and TCS, I think, 3 or 4 stocks, which contributed 7.8% of Nifty's return, and Nifty was up about 7.8%. So which means most of the other stocks in the Nifty, forget about the mid caps, many of them were at 52-week lows and they actually did not contribute. And looking at where the index went is kind of the incorrect way to that's how the world looked at it, saying that look, Nifty is hitting new highs. It was just actually 3 or 4 stocks which are hitting new highs. So from that perspective, A, it's not an overheated market, and B, in the sell-off, lots of the mid caps have reproved themselves in terms of their earnings are intact and are now at attractive valuations across the board. And primarily actually industrials, consumer durables, because these are the more cyclical sectors. And I think that's where we are finding a lot of companies attractive.
Consumption is a space, value and expense, expensive but valuable.
Yeah, consumption, again, you're going into the traditional festive season for the next several months. And therefore, yes, and value, we're more growth guys, so we see growth out there and we're focusing on that.